You can feel it in the metals market right now. That heavy, pressurized silence that always comes before something snaps. I've been in this space for a long time, watching physical silver flows, derivatives, and institutional positioning, and this tension isn't normal. It's the kind of atmosphere that shows up right before price stops obeying the narrative. I'm here because I don't like being late to those moments, and I don't like being lied to by delayed headlines that pretend nothing unusual is happening. I've been trading commodities and stacking physical silver for 12 years. I built this channel because I was tired of seeing mainstream outlets explain the market hours after the real move already happened. By the time they publish a story, the opportunity is gone. Meanwhile, algorithm-driven channels recycle hype and call it analysis. I use this format for one reason: speed. No theatrics, no noise, just what the data is showing right now while it still matters. And tonight, something important is unfolding. Something financial media refuses to touch because it exposes a mechanism that only works as long as people understand it. This morning, silver was aggressively slammed. At 9:45 Eastern, price dropped roughly 4% in minutes. That kind of move isn't organic. It's designed to hit stop losses, force weak hands out, and scare retail investors into abandoning the sector entirely. The official explanation is predictable. They'll tell you this was a healthy pullback, a cooling phase after a strong run. They want you to believe retail investors panicked, lost conviction, and rotated into whatever asset class is being promoted this week. But that story falls apart the moment you stop looking at headlines and start looking at correlations. Because while silver was being dumped, something very different was happening underneath the surface. While spot silver was down hard, the mining equities barely reacted. The primary silver miners ETF opened down roughly 1.5% and quickly began recovering. Read that again. The metal dropped 4%. The producers dropped a fraction of that. That's not weakness, that's relative strength. And relative strength during a forced sell-off is the first warning sign that the public narrative is wrong. That divergence matters more than most people realize. When the underlying commodity gets hit hard, but the companies that produce it refuse to follow, the market is sending a message. It's saying that someone with size is defending a level. Retail traders don't do that. They react, they panic, they follow price. What you're seeing instead is controlled absorption. Large players stepping in quietly while fear is being manufactured on the surface. And the timing of this move is not random. As you're watching this, we are less than 12 hours away from the third Friday of the month, monthly options expiration. OPEX. If you've been around these markets long enough, you already know what that means. This is the most dangerous window of the quarter for institutional short sellers. It's when derivative exposure either quietly expires or detonates violently. There's a reason the miners are being held back. It's not because they're weak, it's because they're tied to an extremely expensive anchor. Right now, silver miners are being artificially suppressed to protect massive short positions sitting on bank balance sheets. That's the thesis. And over the next few minutes, I'm going to show you why that suppression becomes unsustainable the moment options pressure is released. Here's the core conflict. Silver is trading near $90, but mining equities are priced as if silver were still in the $30 range. That's not a normal lag. That's not slow price discovery. That's a structural distortion that should not exist in any rational market. Under normal conditions, miners lead the metal. Right now, they're being pinned down, and this is where operating leverage comes in. This concept is the key to understanding why the setup is so dangerous for shorts. Mining costs don't move the way prices do. Labor, fuel, equipment, permits, those costs rise slowly. Revenue, on the other hand, explodes when metal prices move. That gap between fixed costs and rising prices is where profitability goes vertical, and that's exactly what's happening right now. Let me slow this down and make it crystal clear, because this is where most people miss the trade. Mining companies operate with largely fixed costs. Once a mine is built and running, the cost to pull each additional ounce out of the ground doesn't change much month to month. So when silver was trading in the 30s, margins were thin. These companies were surviving, not thriving. Investors learned to ignore them. That mindset hasn't caught up with reality yet. Right now, the average all-in sustaining cost for silver miners sits around $30 per ounce. That number includes labor, fuel, maintenance, permits, taxes, everything. When silver trades near $90, that's a $60 margin on every ounce produced. That's not incremental improvement. That's a complete transformation of the business model. Profitability doesn't double or triple. It explodes. Yet the stocks don't reflect that math. They're still priced like silver is stuck in a low-margin world. This disconnect isn't subtle, it's extreme. And extreme disconnects don't last. Markets eventually resolve them, and when they do, the move is fast and violent. That's why this setup is so dangerous for anyone betting against these companies. Now, skeptics will say costs are rising too. Diesel is more expensive, labor costs are higher, equipment prices have gone up, all true. But here's the problem with that argument. Costs haven't tripled, Silver has. Even if all-in costs rose by 30%, margins still expand massively. You can see this in the earnings reports. Free cash flow is surging, debt is being paid down, dividends are rising. That's why I'm saying this isn't speculation, it's arithmetic. The numbers are already there. The only thing missing is price recognition. And that recognition tends to arrive suddenly, not gradually. Especially when derivatives pressure forces participants to stop pretending the old pricing still makes sense. Now this is where the banks enter the story, and this is where things get uncomfortable. Large financial institutions aren't neutral observers in this market. They are deeply embedded in it through derivatives, swaps, and short positions that were built when silver was much cheaper. Those positions don't unwind easily. When price rises too fast, losses accelerate, and that creates urgency. Urgency leads to intervention, not transparency. One of the primary tools used to manage this pressure is the options market. Monthly options. Expiration is not a footnote, it's a battlefield. Billions of dollars hinge on whether silver settles above or below specific strike prices. If silver stays elevated into expiration, call options move in the money, forcing sellers to hedge or buy underlying exposure. That feedback loop is dangerous for anyone short. That's why price behavior around expiration often looks irrational. Sudden drops, sharp reversals, moves that make no sense if you're only watching headlines. But they make perfect sense if the goal is to push price below key levels just long enough for contracts to expire worthless. It's not about long-term fundamentals in those moments. It's about survival. What makes this cycle different is the miners. In past suppression events, mining stocks usually collapsed alongside the metal. This time, they didn't. They held their ground. That tells you something critical. It means someone is absorbing selling pressure. It means capital with a long time horizon is stepping in quietly while volatility scares everyone else away. And that's the warning sign. When suppression starts to fail, it doesn't do so gradually, it cracks. The moment derivatives, pressure eases, the underlying fundamentals reassert themselves all at once. That's when valuation gaps close violently. That's when lagging sectors don't just catch up, they overshoot. This brings us to the critical question. What happens when this pressure finally releases? Markets don't resolve structural distortions politely. They don't drift back into balance. They snap. When suppression mechanisms fail, price doesn't ease higher. It gaps. That's why the quiet strength in miners matters so much right now. It's the market positioning before the public narrative changes, before the headlines flip from dismissal to shock. I've seen this pattern before. The disbelief phase always looks the same. Commentators call it a dead trade. Analysts downgrade at the bottom. Retail investors give up right before the move starts. And then suddenly, the same stocks that were ignored for years are everywhere. Not because something new happened, but because reality finally became impossible to ignore. That's the stage we're approaching. What makes this moment especially dangerous for short sellers is that there's no clean exit. Covering pushes prices higher. Rolling positions forward becomes expensive. And waiting increases risk. That's how pressure builds invisibly, until one catalyst forces everyone to react at once. Options. Expiration isn't the cause of the move, it's the stress test that reveals whether control still exists. If silver holds these levels, and the miners continue to refuse lower prices, the message becomes unavoidable. The valuation gap is no longer defensible. At that point, capital doesn't rotate slowly, it rushes. Funds that ignored the sector are forced to chase. Algorithms flip from sell to buy, and what starts as a catch-up becomes momentum. This is why I'm not focused on intraday noise. I'm watching behavior. I'm watching what refuses to break. I'm watching who steps in when fear is manufactured. Those signals matter more than any single candle on a chart. Price tells a story, but participation tells the truth. We're not at the euphoric phase yet. That comes later. Right now, we're still in the window where positioning quietly determines outcomes. Once the move becomes obvious, the edge is gone. Preparation always happens before recognition. And that's exactly where we are tonight. Let's drop the politeness for a moment and talk about power. Markets are not democratic. They are hierarchical systems where size, leverage, and timing dictate outcomes. When suppression appears, it is never accidental. It is deployed by entities with exposure large enough to justify intervention. That alone tells you something important. Nobody defends price levels aggressively unless losing them would cause real damage. The effort itself is evidence of stress. The analytical mistake most people make is assuming price equals truth. It doesn't. Price reflects the current balance of force, not fundamental reality. When leverage dominates, price can be pushed temporarily away from equilibrium. But leverage has limits. Every derivative position is anchored to margin. Institutionally, this is where internal risk committees start panicking. When VAR models stop behaving, desks get constrained. When desks get constrained, liquidity vanishes. And when liquidity vanishes, price gaps violently through levels everyone assumed were solid. That's why suppression phases often end overnight or during illiquid sessions. Control fails when no one wants to make a market. The most dangerous assumption right now is believing this can unwind slowly. Crowded trades rarely do, especially when leverage is involved, especially when options expiration compresses time, especially when physical constraints exist underneath paper exposure. Slow exits require cooperation. Forced exits don't ask permission, they just hit. There's also a timing component most retail traders never consider. Large players don't need price to rise immediately. They need price to stay above pain thresholds long enough to force repositioning. That's why defense zones matter more than breakouts at this stage. Survival first, expansion later. Think about the psychology of a short seller here. You've been right for years. The strategy worked. Price always came back down, then suddenly it doesn't. You tell yourself it's temporary. You add, then volatility spikes. Margin requirements increase. Correlations break. And now the trade isn't about profit anymore. It's about survival. That's when rational analysis dies. This is also where narratives flip, not because facts change, but because incentives do. Analysts who ignored miners will suddenly discover valuation upside. Media that dismissed metals will find reasons to talk about them, not at the bottom, after price forces their hand. That's how narrative always works. Price moves first, stories follow. From a macro lens, this setup aligns with broader instability. Debt saturation, currency debasement, geopolitical fragmentation, and declining trust in paper promises all converge here. Precious metals don't need perfection to rally, they need doubt. And doubt is everywhere once you stop listening to headlines. The mistake most people make is waiting for confirmation that feels comfortable. By the time confirmation arrives, asymmetry is gone. The risk-reward flips. Early phases feel wrong, they feel lonely, they feel manipulated. That discomfort is not a bug, it's the filter. So here's where everything converges. This isn't about guessing tomorrow's candle or pretending anyone can time the exact moment pressure releases. This is about recognizing structure before it becomes obvious. Silver is trading at levels that mathematically invalidate current mining valuations. Options positioning is compressing time. Physical supply constraints are tightening the noose underneath the paper market. And institutional players are boxed in by leverage they can't unwind quietly. When these conditions align, markets don't drift. They reprice. And repricing never feels orderly to those on the wrong side. It feels chaotic, irrational, and unfair. That's because it is. Forced buying doesn't negotiate. It doesn't respect narratives. It only respects margin. If the suppression mechanism fails, even briefly, the response won't be gradual. Algorithms flip, hedges unwind, shorts cover into illiquidity, and suddenly the move everyone said was impossible happens faster than anyone expected. That's how every major catch-up rally in history begins. Not with headlines, with silence, then violence. You don't need belief to understand this. You need math. And the math is clear. Operating leverage hasn't disappeared. It's been ignored. But ignored pressure doesn't dissolve. It accumulates. And when it releases, it rewrites prices to match reality. This isn't about being right. It's about being positioned before the crowd understands what just happened. If this analysis helped you see the market differently, support this work. Like the video, subscribe to the channel, and share it with someone who still thinks price equals truth. Independent analysis only survives when people choose clarity over noise. Leave your thoughts in the comments. That's where the real discussion happens. And if you want to go deeper into how these mechanisms really work, watch the video appearing on your screen now.